to join the session already, and we're just gonna start this. Good morning, good afternoon, good evening, wherever you're joining us from. Welcome. Thank you for joining us for this live discussion on one of the most controversial and highly debated topics in personal finance, which is renting versus buying a home. At the end of this session, we're hoping that you're going to find this very informative, and we're also hoping that this is going to be a very interactive session. My name is Blumina Morin, your trusted money coach, and I'm going to be co-hosting this session together with my colleague Isaac Jonas. We're very excited to have you join us for this live discussion. So before we jump into the item on the docket for today, some housekeeping items. As you might be aware, this is a live session, meaning that we're going to be recording this conversation throughout the webinar. So if peradventure you're not comfortable with this, we highly suggest that you just excuse yourself, or you just simply turn off your camera. And if you have any question, you can always use the reaction button for you to ask any question. The reason why we're saying this is because we're going to be sharing this webinar together with people in our community, and we're also going to be posting this across our social media platforms. So if you're not comfortable with this, you can simply just turn off your camera and then ask your questions in the chat session. So, and apart from that, we also suggest that you please mute yourself. We're going to open up the floor for Q&A at the end of the presentation, because our goal is to start off with a brief presentation, and after that, we're going to open up the floor for Q&A. Okay, so I hope everyone is good with that before we jump into today's session. So, what do we have on the item for today? Number one, the welcome, which we've already welcomed you already. We're very excited to have you join us for this session. After which, we're going to have a brief overview or the introduction of our host. We're also going to share our community goal and also the agenda for today. After which, we're going to leave this open for Q&A. The goal of this is just to have this conversation for an hour. Again, as I said before, we're going to have a brief presentation, after which we're going to leave about 30 minutes for Q&A session at the end of the presentation. So, brief introduction of myself. I'm Blooming Umorin. Most people call me Blooming, my trusted money coach. I have an MBA degree from the University of British Columbia, and also my first degree was in the US in BSc in Economics and Accounting. I came to Canada on a full ride scholarship from the MasterCard Foundation, and I love to talk about money, crypto, and stock market investing. So I'm going to turn this over to Isaac.
Thank you so much, the Money Coach Blooming. I'm Isaac Jonas, and I'm the principal consultant at Streetwise Economics, currently based in Canada. I earned two master's degrees, namely Master of Food and Resource Economics and a Master of Arts in Environment, Resources and Sustainability at the University of British Columbia. And I'm also an economist by training, having earned a bachelor's degree in economics at the University of Zimbabwe in 2010. Over the past couple of years, I've been awarded over $200,000 worth of scholarships and fellowships, particularly at the University of British Columbia. I love to talk about personal finance, investing, and career guidance. Next slide. Now, in the interest of full disclosure and full disclaimer, my colleague and I, we just want to make sure that this conversation is not to be taken as investment advice. These are just our views, and what we shall share here is by no means investment advice. You must always consult your financial advisor. And ultimately, the decision when you're investing your money is yours.
So, in terms of what to bring for today's session, we highly recommend that you have your writing material with you, because as we go through this webinar, you're going to have one or two questions, and it's important for you to jot it down so that you don't lose your train of thought by the time we open the floor up for Q&A. And also, if you want to bring coffee, tea, water, juice, whatever tickles your fantasy, Apparently, I didn't even bring my own cup of coffee here because I was just preparing for this. But again, if you want to bring coffee, drink water, anything that tickles your fantasy, no alcohol. I know we want to stay sane. We want to stay productive throughout this 1 hour conversation. So then over to you, Isaac.
Thank you. And for us to maintain a respectful engagement, please just treat each other with respect because we want to learn from each other and have a focused discussion wherein we share valuable insights. Now, in terms of the agenda for the day, we're going to talk about the pros and cons of renting and buying, or renting versus buying, but also we're gonna give a deep dive into the fixed and variable mortgage rates, in particular within the context of the Canadian real estate, using some real data, and also talk about what it means to be buying a home within your means. And hopefully at the end of this conversation, we will give you an opportunity to share your experiences, lessons learned, and mistakes, because the goal ultimately is for us to have a conversation and to talk, because investing, particularly in real estate, is very personal. So we will go through this presentation and give you a chance at the end to have questions and answers. So just make sure you note down your questions, and then we can address those questions at the end of the presentation.
So now we're going to jump into the main agenda for today, which is rent versus buy. Before we jump into this, I want to really emphasize that personal finance is more personal than finance, meaning that what is going to work for one person might not necessarily work for another. We're just having a conversation today. Either you're a renter or you're a home buyer or you're a homeowner, it doesn't make any difference. What we're just presenting to you today is just to have an informed decision, an informed conversation, so that when you ultimately either want to buy or you still want to keep renting, you're going to feel comfortable with the decisions that you're going to be making. So, the easiest one is renting. Sorry, I'm going to admit somebody in here. So the easiest one is renting. This is very easy. We're very familiar with this. In terms of the advantages of this I'm going to run through very fast because we're very familiar with this. It's very flexible, right? You're easily able to just relocate maybe for personal reasons or for career reason. You're within a shorter commitment period. And apart from that, there is much lower upfront cost, meaning that you don't need a large down payment just to be a renter. And apart from that, there are no maintenance costs, meaning that as a renter, the landlord or the landlady is literally responsible for any repairs or maintenance that you're going to have. And because of this, you have little to just worry about in terms of maintaining the house. Number four, because you are a renter, your finances is more predictable in terms of your rent, meaning that it's going to be fixed usually for a period of 1 year. You don't have to worry about that. And this makes budgeting even very easy as a renter. And apart from that, as a renter, you don't need to worry about the property taxes because these are things that the landlady or the landlord is going to be responsible for. And because of this, this whole experience simplifies your financial planning experience. So, in terms of the disadvantages of renting, one of the first few things that a lot of people usually say is that if you are a renter, sorry, I'm sorry, I need to keep admitting people in here. Sorry, admit all. Okay, so one of the key disadvantages that a lot of people talk about when they are renting is number one, there is no equity built into this, meaning that when you're renting, you don't really own the home, you're missing out on potential appreciation of the property. But I'm going to say that this comes with a caveat because your primary residence is not the only form of way to build equity. There are other vehicles through which you can build equity, for example, in the stock market or even in crypto. So again, these are things that we're going to go through by the time we run the numbers so that you actually understand what it truly means to build equity over time. Yes, you can build equity in the home, but that might not be the optimal way of building equity, which we're going to explain further as we go through this webinar. Even as a renter, it's important to know that there's always that possibility for your rent to increase given market conditions. But even with the rise in the cost of renting, your rent is not going to be so outrageous. For example, if, for example, here in Edmonton, a two-bedroom just goes for about 1,500, the landlord or the landlady cannot just raise this up to 3,000. These are not market conditions, right? So again, even though your rent is going to increase, it doesn't mean that it's going to be outrageous. And because of this, you also know that you might have less control over the long period of time if you just stay a renter. Again, either you rent or you buy, it doesn't really matter. It depends on your personal preference. One of the other disadvantages as a renter is also because there's limited customization, meaning that you cannot just wake up one day and paint the whole structure in color red. No, you're not the owner of the house. You can't really do all of this customization. So it's very, very limited. And the other things to also consider as a renter is that there might be the possibility of non-renewal of your lease. I mean, this can also work even for a home buyer, meaning that at the end of your term, the possibility of you refinancing with the same lender might be different. Maybe your financial conditions has already changed. But as a renter, there is always that possibility for the landlord or the landlady to say, hey, I want to sell this property. And that means that you have to leave and just pack your bags. So these are things that you need to consider as a renter. Another point that a lot of people talk about as one of the disadvantages of renting. Oh, great. Can you please excuse me? My battery is low and I can't believe that I didn't plug in my computer. I'm sorry. I'm so sorry.
Um, just in terms of to, just, take over from what to explain from what Blooming was, talking about
Okay.
as you are plugging your
Okay,
battery.
I'm good.
Okay, good.
I'm good. So,
No
in terms
problem.
of the tax benefit, I know a lot of people will often say that as a renter, you don't have any tax benefit because you can't really deduct a mortgage interest, right? But this might not be also necessarily true because there are a lot of vehicles like the FHSA or the TFSA that you can even still get tax benefit from. Again, there is no right or wrong answer depending on your preference as an individual. So in terms of ownership, I know that this is the place that everybody wants to be. You want to be a home owner. You want to have your own space. You want something that you can call your own, which is always very, very exciting, especially as a first-time home buyer, right? But let's look at some of the advantages of this. The first thing that a lot of people usually say is that, yes, I'm building an equity, meaning that when I buy my house, I can just build equity over time. Anytime you make a mortgage payment, you're literally contributing to the equity of the home, meaning that you're owning part of the home. Okay? And as much as this is correct, by the time we run the numbers, we're going to see if maybe this is the most optimal way or not. But again, we're just putting out this information. Number two, as even as the value of the home goes up through the years, and usually because of inflation, your net worth is going to increase as a homeowner. Number two, we believe that value of properties appreciate over time. As a homeowner, again, in the long term, it's appreciate over time. The rate of appreciation might be different, but again, it appreciates over time. As a homeowner, some of the things that you also need to consider, especially if you are a family person, that it gives you a lot of stability, meaning that you don't want to keep just on seeing your family every 2 years, every 3 years, because the landlord or the landlady wants to renovate the house. So again, it gives you a lot of stability. And in terms of personalization, if you want to personalize the house, you want to paint it pink, purple, blue, nobody is going to question you because this is your own house. In terms of the tax benefit, there's always that possibility for you to deduct mortgage interest by the time you file your taxes the following year. Again, this is not the only option because there are other advantages either as a renter or as a home buyer. One of the other advantages that a lot of people often say is that this forces individuals to literally save because Over 33% of Canadians, they consider their primary place of residence as a form of long-term investment. So again, this is something that a lot of people, they are forced into saving because you're committed into paying this for a long period of time. And because of this, you can build equity. But when we consider the disadvantages of home ownership, number one, you need to consider that you need to put down a sizable amount of down payment, maybe 5%, 10%, 20%, depending on your preference. And you also need to consider the cost of closing the whole financial transaction. And even over the years as a homeowner, you're responsible for maintenance and repair of the home so that your home doesn't, it doesn't look shabby, right? So again, these are things that you need to factor in. Unexpected expenses, for example, if the hot water tank was to just blow up or it's just winter and it's minus 40 degrees Celsius and your pipe just literally freezes, what are you going to do? Or it just busts, right? As a homeowner, these are some of the expenses that you need to factor in. And also, it's important to factor in the market risks. What do I mean by this? Most people always assume that the value of a home goes up substantially over time, but that is not necessarily true. I've had conversations with people that bought their house maybe 10 years ago and now they want to sell it. But because the market was down, by the time they eventually sold the house, they were at a loss. So we should never just have this blinders on that, oh, the value of the property always goes up. It really depends on market condition. We can be in a recession, we can be in a depression, and this is going to affect the value of the home. The other things that we also need to consider is a long-term commitment, meaning that as a home buyer, you're going to be committing yourself to 15, 20, 30, or even sometimes longer mortgage terms. So when you're doing that, there's always a possibility that something can happen within the said 15, 20, or 25 years. Maybe you lose your job or your business goes down or something happens. And if peradventure you're unable to make this payment, this can be a lot of financial stress on yourself and even of your or on your loved ones. The other thing to also consider is the ongoing property taxes. I've never met a homeowner that told me, "Oh, Blooming, my home, the property taxes I'm paying has been going down for the past 5 years, and I'm so excited." No, it's always, "Oh, the property taxes is always going up, the insurance that you pay is always going up," which is understandable as a homeowner. These are things that you need to factor in before making the biggest purchase of your life. Again, there's less flexibility, meaning that if I wanted to leave Edmonton and I wanted to go to another country, I need to find a way to sell this. This can be very time consuming at times. And also, there's a possibility of putting a lot of financial strain on the individual or the family should the source of livelihood just get shut down, meaning that you lose your job or something happens in the family that you're unable to work. Again, because I've seen situations whereby you've been making a mortgage payment for the past 10, 15 years, and all of a sudden you're unable to make the next set of payment. There's always that possibility of a foreclosure on your home. Why? You technically don't own the home until you make the last payment. The bank still owns the home. I know, and a lot of people always have the impression that when I buy a house, and I take out this mortgage, then technically this is now my own house. No, it's not your own house until you eventually pay off the mortgage. So now this is another important the decision in terms of the type of mortgage rate you're going to get. And I'm going to turn this over to my colleague, Isaac.
Thank you, Money Coach. Now, another important aspect to consider when you're, considering buying or getting into a mortgage, particularly giving Canada as an example. Here in Canada, people normally get into a 5-year term. In other words, they renegotiate their uh, mortgage rates, like in terms of the fixed or variable every other 5 years. But what happens is that if it's fixed rate, right? It means your payments are predictable, and when it's variable, it means it can vary over time. So this is where things can get very complicated. If it is variable, it means, if the central banks, for example, Bank of Canada, changes the interest rates, it might have a knockout effect on your mortgage payment, because if they increase the interest rate, for example, they started increasing interest rates, including in the US, where the Federal Reserve Bank has been considering now decreasing the interest rate. But since June last year, they've been increasing interest rates. So what this means is that some people who were on variable interest rates, it means their mortgage rates actually they increased as well. So it's not common that a lot of people get their raises, so what that means is it might give or put people in the financial stress, because if interest rates increase and then you have to increase your payments. So you have to be very, very careful in terms of the interest rates. Either if you go on the fixed route, it means you have predictable payments, right? But if you go on the variable, then there is unpredictability. But sometimes if the interest rates decrease, you might possibly end up paying a lower mortgage rate down the road. So it's something to be aware of. Now, in Canada, we have, of course, 10 provinces and territories. So some of these conditions or situations may vary from place to place, but generally these are the current interest rates that I saw online. And you will see that a 5-year period on average, if it's insured, in other words, let's say if you have 20% down payment, it's on average 4.4%. But, if it's variable, right now you're looking at probably 5.65%. And moving on to the next slide, you can see that, let's say hypothetically, in the context of Canada, and then this may vary from different places, but generally, what happens is that if, let's say, if you wanna get into a mortgage for 1 million, and then for an interest rate of 5%, let's say if you go with BMO, the average mortgage payment would be 5,816. That is excluding any other cost, right? Like insurance and other phantom costs. So this is the reality of this. And so if you include those other costs, it might be 7,500 or something, even more. So this is something to be aware of. But you can see that here, if you have an amortization table, you can go for either fixed interest or variable interest rates. And in Canada, like I said, usually it's 5-year term and you negotiate, or some people can even do less. So this is something to be aware of. Now over to you, Blooming. Sorry, you're muted.
Sorry. So in terms of buying within your means, whether you're buying a condo, a townhouse, duplex, or a single family home, it's really important to run the numbers, because majority of times when people are comparing whether to buy or to rent, what most people actually just do is they just look at the rent amount and they compare it to the mortgage payment. Those are not comparing apples to apples. You're literally comparing different things, and I'm going to run you to what I mean by this. So, for example, if I were to be a renter, the only two things that I typically would just consider is number one, the monthly rent and also the utilities. But if I am a homeowner, I'm going to consider the mortgage payment, number one. Number two, I need to consider the closing costs. I need to consider the interest, which is the cost of borrowing, the cost of taking out the mortgage from the bank. Number three, I need to consider the property taxes, which is usually substantial every year. Number four, you need to consider the insurance, the maintenance, the renovation, even the transaction fee. And apart from that, the opportunity cost of investing in real estate versus stocks. And before we can even make this decision, I want us to run the numbers. This is the most exciting part that I love to talk about, because the moment you run the numbers has the ability to just communicate with you or to talk. Okay. So I'm going to just click on this. And today we're going to be using the New York Times rent versus buy calculator just for simplicity. And we're going to be making this assumption. Let's say hypothetically, somebody wants to buy a property of $500,000, okay? 500,000. And I have somebody else that wants to rent maybe a two-bedroom for 1,500 here in Edmonton, Alberta. And these individuals, they are going to be in this house for the next 10 years. That's where we have the duration here. In terms of the mortgage, let's say they have a very fantastic credit score and they're able to get a mortgage fixed rate for 5%. If we scroll down and this individual puts down 5%, which is usually what most people put down, again, you can run these numbers. Maybe you want to put down 10%, 15%, 20%, or even higher. But we're trying to be very conservative here. And let's assume that the length of the mortgage is just 25 years. And because we're putting down 5%, that means that we're going to be paying for PMI to that's the private mortgage insurance. So we're assuming a 1% on that. In terms of the growth of your home, we're expecting that this is a global rate of return. We're assuming 4%, that your home is going to appreciate for 4% annually. Again, this can vary, but we're just being conservative here. And we're also going to make the same assumption that your rent is going to increase at the same rate that your home is appreciating. But let's also consider that instead of buying a home, the renter takes the difference and then invests it in the stock market. And let's just be conservative. We'll put this in the S&P 500 and assume a 10% rate of return. Historically, the S&P 500 has returned about 10% annually. Again, this can go up, it can go down. Just this year alone, the S&P 500 has already returned over 15%. But I'm telling you that historically, the S&P 500 has returned about 10% annually. And let's also make the assumption that inflation is going to be around 3%, property taxes 1.3%, which again, being very, very conservative here, and we have some closing costs here. Maintenance just 1%, home insurance and utilities $100. Utilities is usually more than $100 every month, but we're just making this very, very simple. And just putting this in the New York Times rent versus buy calculator, you can see that after 10 years as a renter, you'll be better off because you're going to have over 200,000 just sitting in your investment account. Again, there is nothing wrong in buying or renting. It's just something that you need to consider because sometimes when most people just consider just the mortgage payment with the rent, it's not a good comparison because you always have to consider the opportunity cost of just tying down the capital. And what do I mean by this? Let's run another numbers. We're going to be looking at the mortgage calculator, the same $500,000 house. I put down 5%. The term of the mortgage is 25. Again, you have a fantastic credit score and the interest rate is 5%. Property taxes, we're going to assume 1.2% annually. Home insurance for the whole year, we're going to assume 1,500. And other costs, maintenance, security, things like that. Let's assume this is going to cost us 4,000 for the whole year, which again is very, very conservative. And if we run this number, we come up to a number that every month your mortgage payment is going to be 2,007. That is just a mortgage payment. But by the time you factor in property tax, home insurance, and other costs, your total out of pocket every single month is going to be 3,700. Again, when most people just tell you that, oh, this is just my mortgage rate, it's important to consider the total cost of ownership, meaning the total amount that you're going to be paying every single month. And if we scroll down a little bit, again, the value of the home when we purchase is $500,000. And because we put on 25%, that means that the loan value is just going to be 475,000. And I put on a down payment of 25,000. At the end of the 25 years, I'm not sure if everyone can see the number I'm saying. At the end of 25 years, I took out a loan of 475. The total payment I would have made just for the mortgage and the interest is 833,000 just on the payment that you're making on the mortgage, meaning that at the end of the 25 years you took out 475, but the interest you have paid, my dear, $358,000 just to own a $500,000 home. And that's not even considering all of the total out of pocket. We are still being very conservative. At the end of the 25 years, you would have shelled out at least $1.1 million just to own a $500,000 home. Again, we are not against home ownership. But the moment you start understanding the numbers and you're comfortable with it, and you know that, okay, this is a risk I'm comfortable with, because sometimes when you have a family, you don't want to just upset the family. Maybe you have so many children or you have loved ones around, and you would rather pay this. It's okay. But personally, if you look at the numbers, sometimes this might not make a lot of financial sense, especially if you are a young family. If we, for example, look at the amortization table, when a lot of people say that they are building equity in a home, it's important to also understand the amortization table, because this really explains to you what exactly you are paying. So let's say, for example, here, the interest for the first year, remember, our monthly payment is 2007. So the first year, you're going to be paying over 23,000 just in interest, and only 10,000, less than 10,000 is going into the principal. And when you hear people say, I'm building equity in my home, yes, you're building equity, but you're literally giving the bank more than 2 or 3 times of how you're paying down your principal. And the irony of this is that if you just look at this amortization table, the interest you're going to pay for the next 10, 11, 12th year, it's until year 12 that the interest you're going to be paying is going to be almost at par with the principal, meaning that for the first 11 years, you're paying more in interest compared to the principal. At the end of 12 years, your principal is still 318. So again, when we start talking about the total cost of ownership, buying versus renting, there's absolutely nothing wrong in either a renter or a buyer. But it's also important to run the numbers, because once you run the numbers, you start seeing clearly that when somebody is telling you that you're just throwing rent away or you're just throwing money away when you rent, that's not entirely true, because instead you're giving all of the money to the local bank. Even though, yes, you're building equity, but this is not the only form of equity that you can build. You can build equity in the stock market too. So let's say, for example, instead of me buying a house and shell out $3,700 every single month, and I can instead rent for 1,500, the marginal difference is about $2,000. Okay. So let's plug this into a compound interest calculator. I take my down payment of 25,000. Remember, we put down 5% as our down payment. Then we invest this in the S&P 500 for 25 years. And the extra money that I should have been paying towards owning a home, I just rather invest that every single month, which is 2,200. And I just invest that, and I just invest this very conservatively in the S&P 500. I'm not even talking about the growth stocks, right? Very conservative. And I do this for the next 25 years. At the end of the 25 years, I'm going to have over $3 million. Over $3 million. So let's even say, okay, I'm going to pay some taxes on this. Okay, maybe I end up with 2.5 million. So I can still take $1 million. I can still take $1.2 million and buy a brand new house, cash down, and I still have an extra 1.2 or 1.5 million just to chill out. So again, it's important to understand the numbers when you're making the biggest purchase of your life. Yes, it's good to be a homeowner, but there's absolutely nothing wrong in being a renter, provided you just invest the margin, meaning that the same money that you'd have invested or the same money that you'd have put towards buying a home, you just consistently invest that in the stock market, you might possibly again do way much better. So I know this is a lot of information that I've just thrown out. I know this can be very overwhelming, but as I said before, it's important to understand the numbers, because anytime we hear on any of these housing myths, when you rent a house, you're just paying your landlord's money. If you're renting, you're essentially throwing money away. When you buy a house, you're building equity. It's not necessarily true, because when you tell me that I'm paying my landlord's money or my landlord's mortgage, if you're a homeowner, you're literally giving more money to the bank. So who is the smarter one, right? Again, if you're renting, it doesn't necessarily mean you're throwing money away. It just means that you need to invest the difference. And even when we talk about building equity, there are different ways for you to build equity, because it doesn't make financial sense to me for me to pay down my mortgage less than $10,000 in year one and I give the bank over $23,000. Again, it's important to run the numbers. And just from running these numbers, what we can see is that if you're a home renter, if you're renting without investing, you are definitely 1,000% throwing money away. I'm going to say that again. If you're renting without investing, you are literally throwing money away. So because investing is really the delta that makes the difference. In as much as you're a homeowner, it's also very important to invest. But it's even more crucial as a renter to invest because yes, you might think that you're throwing money away, but if you're not investing, I can guarantee that you're just wasting the money because it's the investing in the stock market or peradventure in crypto that will give you the delta that you're looking for. So again, either you pay the interest to the bank or you take that same money and invest in and build wealth for yourself. Sometimes they can be a better option. Even as a homeowner, or before you become a homeowner, it's important to not just look at the rent that you're going to be paying versus the mortgage payment. It's important to evaluate the total cost of ownership, meaning the other phantom costs, the maintenance, the utilities, the HOA fees, transaction costs. These are things that you need to consider because rent is the maximum you're ever going to pay. But the mortgage is the minimum because there are other phantom costs that you need to put into consideration. So I'm going to turn this over to my colleague, Isaac.
And thank you so much for doing that breakdown. And I just wanted to mention that, Blooming and I, if you want, like specific situation that you want us to run through, then we will give you our information so that you can consult with us. Again, situations differ, but the reason of us running these numbers is to show you, like all sides of the coin, because sometimes people purposefully, mislead people and say things without giving a complete picture. So if you run the numbers, you can see the most important thing is to normalize the data. Renting versus buying, like what Coach Blooming showed in this case, because a lot of people would say, you know, they don't, consider the opportunity cost to say, the difference of paying the mortgage, and the difference of renting, because renting, you can go to a cheaper place. So to summarize this, it's important to run the numbers and understand the implications. But also more importantly, it's important to understand where you are investing your money if you choose to invest your money, because you can possibly lose the money. And it is also important to state that this can hold true under these assumptions. We don't know, and nobody really knows the direction of the real estate market over the next year or the next month. The same goes with the stock market. So this is more like basing this assumption on the past data, which can very well be different in the future. So I just wanted to put that out to say this holds true under these assumptions, these numbers. So please understand the cost of total ownership. You saw that if you include, the total cost of what you actually pay, it's actually way even closer to the same amount that you pay for the mortgage, the nominal value. Now, it's also important to avoid, to understand, the illusion of saying, okay, buying a house, I'm going to be rich, or investing in the stock market. It's important to understand these particular situations, because in most situations, a lot of people, they are house poor. What do I mean by that? It means you have all your money, you know, in a, invested in a mortgage, in a house. But the problem is now, if you have a problem or that house is an issue, you don't have money to fix it. What do people end up doing? They use credit card, they go and get home ownership, or like what do you call this, the line of credit, and it often comes with interest. So what that means is you are in a very terrifying situation. But if you are renting, probably you might lose your job, right? But at least it's different. I've seen a situation, I think that was during pandemic, a client who had a mortgage with TD. I think they were left with a few months to complete their mortgage. They paid a payout of $30,000. Why? Because they breached the contract because they were unable to pay, because they lost their job. So if you commit to a contract of 30 years, it means you have to see it through that. So those are some of the psychological effects. And again, we are not against home ownership. So it's important to understand the interest that you pay out to the banks, because that interest in invest, you can possibly be getting that money if you invest that money and it's accruing to you. So it's the opposite, right, of building wealth in this case, right? And I'm not saying it's bad to invest in real estate. Some people can also do that, using, exchange traded funds that are diversified or focused in that sector, for example, in the US or in Canada. But there is not a lot of commitment in terms of a bigger down payment that is needed. Now, if you invest the money for the extra cost or the difference between the rent and the mortgage, you can find out that if the market performs better as historically over the past 100 years, the S&P 500 excluding dividends has returned 10%. Of course, in Canada, you see that the real estate market over the past 10 years has returned 8.8%. But if you look at a longer time frame, for example, I looked at the data from the Federal Reserve Bank of St. Louis from 1920 to 2023. You see that the stock market is measured by the S&P 500, or that particular index that is exposed to the real estate in the US. It returned better. I think it was 12%, including dividends, versus about 8% for someone who had invested in home ownership, right? So these are some of the things that for me, I consider when I'm considering buying a house. Next slide, please. Now, if you wanna go down that route of buying a house, it is important, sorry, to make sure that you raise as much a down payment, at least 20%, so that you don't end up paying those insurance costs, right? But also, there's a general rule that says, it's a good idea to not spend more than 30% of your gross annual income towards home ownership, because, you end up being house poor, like I explained before. And also another option is to make sure that, let's say if you're planning to buy the house for the next 1 year or 6 months, not put it in the stock market, because the stock market doesn't necessarily go up in a straight line. It might go down 40, 50%. And this has happened in the US. You see, in the 1930s, it went down, as much as maybe over 30%. In 2020, when there was the COVID pandemic, it went down by more than 20%. So if you have your money that you want to buy a house, it means potentially you can lose it if you liquidate at the bottom. So what some people do is there are a lot of high yielding savings accounts. There are many of them in Canada, in the US, and in other part of the world. What that means is you get your principal, and then when you then make that decision, you can then just get your principal plus some interest to cushion you from inflation, because inflation is a silent tax. We know in the US it has been 3.45%, in Canada 3%. So it means, your money, if you have 10,000 at the end of the year, it will be in real sense 7,000. Now, it's also important to understand that there are different mechanisms to actually take advantage of. In Canada, we have the first home buyers account, and also even RRSP. There are different ways to optimize taxes, in the sense that what you then do is you can put that money up to the limit. For example, the first home savings account, you put maybe 8,000, your spouse put 8,000, and then that money is tax free if you then withdraw it with the intention to buy a house. So you can take advantage of those other tax benefits. Next slide, please.
All right.
So
So,
over to you. Thank you.
yes. So, as we're going to wrap up today's session, one of the key takeaways that we're hoping that you would have taken away from this webinar is that number one, rent is the maximum you're going to pay, and mortgage, that's the mortgage payment, is the minimum that you're going to pay. The decision whether to rent or to buy is more of a lifestyle decision than financial. Again, when you run the numbers, it might not make a lot of financial sense, but we humans, we are sometimes very, very irrational. It's very, very important to know that home ownership is more of a lifestyle. You can have a large family, and because you want that stability, you rather home a home, and there's absolutely nothing wrong with that. But it's also very important to remember that if you are renting without investing, you are 1,000% just throwing money away, because investing is a delta that really truly gives you the difference. And you might be wondering, I don't even know how to invest. I don't understand investing. Investing is too risky. Investing is too complicated. That is why we have Isaac and I here. You can always reach out to us. These are things that we coach people on personally. We walk people through how to invest in the stock market. Again, the stock market and the crypto market are one of the best wealth generating tools that humans have ever known, and it's important to know how to invest, because that is where you're going to make more money, not just in home ownership, because your primary place of residence is not necessarily an asset. What is an asset? An asset is something that puts money in your pocket. But when you consider a primary place of residence, that is a liability because it keeps taking money away from you. So when you look at your primary place of residence as an asset, it's technically not an asset, because why? It keeps taking money away from you. So again, it's also important to be mindful of the advice from people. For example, if you go to a mortgage broker and ask, oh, should I buy this house? Obviously, the mortgage broker is going to tell you, yes, you should buy a house. Because why? There's some financial benefit to the mortgage broker. If I go to my bank, should I take out a line of credit? Should I buy this home? Yes, the answer will be yes, because they know that they're going to make a lot of money from the interest. So it's very, very important to make sure that whoever is giving you advice doesn't have an ulterior financial motive behind it. And that's why it's always good to seek out a trusted financial mentor that can just coach you and just show you that, hey, objectively, if you want to run these numbers, I think this is something that you're able to afford. So again, as we wrap up this conversation, we truly, truly hope that you've been able to learn one or two things from today. This is also an opportunity for you to join our investment community. If you're not part of our community already, for example, we talk about the stock market, the crypto market, we talk about what is going on in the market. If this is an opportunity that you want to be part of our community, please reach out to either Isaac or I. We'll be more than welcome to welcome you to our community. And now we're going to leave the floor open to Q&A. This is the most exciting part. We want to hear from you. I know we've thrown a lot of things at you already, so please, we're going to open up the floor for Q&A. And when you start, tell us your name, your country, and your question.
Sorry,
So,
I just wanted to add one quick point before I allow Michelle. I saw you mentioned something. I think
yes,
it's also important to mention that there are some caveats. Let's say when you are, buying a house, and some people they can have someone to rent the basement. There are various ways to kind of like lower the risk, right? But those are specific nuances, okay? I just wanted to mention that in addition to that. But I see that Michelle, you wanna go first. Please go ahead and like what Blooming mentioned. Thank you for your audience.
Thanks, Isaac. Thanks, Blooming. Thank you so much. Those numbers were very helpful to kind of break out things for folks to see, especially that amortization schedule. Because
mhm,
for the most part, except if you have worked in credits or within the banks, most times you don't see those back end numbers and see specifically that split between your actual loan payment and the interest portion that you're paying. What sometimes I think most people don't realize, and I understand sometimes most people, depending on your situation, if you have a big family, you don't want to move around so quickly and all of that, home ownership might be the best what's it called, path for you. And you might not have, the funds to, after paying all of these things, still put something in the market. So it gets tough to have that freedom of fund, especially if you're house poor. What I can advise, which I have seen from being within the banking system and working in mortgages and all of that, is talk to your bank. Most banks, they won't tell you this outright, but you are allowed to make some prepayment towards your loan balance every year, some portion without getting a penalty.
Yes.
What that does is if you go and you have some bulk sum of money sitting somewhere, you can go to your bank every year and say, hey, I want to make XYZ amount of prepayment towards my principal. Specify that it's going towards your principal. That money goes and it reduces how much you actually owe. What that does, remember, the interest you're paying to the bank is interest on the amount that you owe them. So they try as possible to scale that money so you owe them more at the beginning of your mortgage and less towards the end. So they get the high mortgages upfront, which is why they try to penalize you if you pay too much as a prepayment. But they allow, I think, about 10% or so thereabouts as a prepayment every year. That's enough. I can't remember how much exactly. So go to your bank every year, ask them, what's the most I can prepay on my mortgage this year? They'll give you a figure, they'll run the numbers. And then if you pay that amount, what happens is the next year, instead of that split between your interest and principal being about 70 to 30 or 75 to 25, it drops to about maybe 60 to 40 or thereabouts. But then if you can do that and have in mind that I want to pay this off as quickly as possible, because the longer you owe, the more you pay in interest. So if you're able to prepay early, you're able to potentially reduce how long your mortgage runs. So it ends up being about that 15-year line, whatever that Isaac had referred to, instead of 25 or even 12 or shorter. But just bear in mind that the prepayment is a tool that you have. And if you have spare funds sitting somewhere, instead of having that, I mean, don't give up your coffee or whatever, but instead of having those extra trips that you don't necessarily need, you can put that towards preparing your mortgage, and that reduces just how much you're liable for in interest payments. That's it.
Yes, thank you
Wonderful.
so much. Thank you so much, Michelle. I mean, that is absolutely fantastic. There's that option for you to pay down your principal. But again, just as Michelle mentioned, that you specifically have to call the bank, tell them, I want this extra payment to go towards paying down my principal. And again, it depends on the type of mortgage plan that you have to, but again, it's an option for you to reduce your mortgage over time. So, okay, more questions. I know we've thrown a lot of things at you. Please, more questions. There is no right or wrong answer here. We just want to learn. We want to learn from each other. Or if you have something to contribute, please.
You can raise your hand and then
Sorry, I can't find where to raise my hand here, please. Can
Okay,
please go ahead.
You can go ahead, sir.
So like you rightly said, I listened to the two of you. Yeah, very good analysis. I think my advice would be, if you want to buy a mortgage,
Yeah.
like Lumi said, you need to run the numbers. If you run the numbers, it's going to be very, very good for you. I will use my own as an example. I'm not going to talk about for anybody or about any situation, but when I wanted to get my mortgage, I made sure I paid 20%. So, and like the last speaker said, I asked them, how much can I add every year? And they gave me those numbers. Now you can add this, you can add that. So what I did was, I look at what I was paying, where I was coming from, and where I was coming from, I was just having a 2-bedroom, which was not good enough for my family. So it depends on the family that you have. So when I wanted to buy the house, I said, okay, if I am going to be paying a rent for a family of 5, at least I will be paying nothing less than 1,600 in mortgage. Sorry, my name is Osmond. I live in Canada. So I calculated this, I ran the numbers, and I saw that. So when I wanted to get my house, I got a very good, moderate place that is okay for me and my family, a 3-bedroom with a basement. It is fully finished, and I dropped 20% of the money. So at the end of the day, what I am paying is not even up to what I will be paying in a 3-bedroom flat.
Yeah.
So what I did was, okay, when I saw that the number was very, very low that I would be paying, I asked the bank, I said, okay, I will be paying double of the amount. And after paying double of the amount, I still find out that it's still almost the same thing with what I will be paying. If I'm renting a house. So when I look at those numbers, it's like I'm not even paying any mortgage. It's like I'm not wasting any money anywhere. So I still have the means to, once I did that, I said, okay, I wanted to be paying double payment. My mortgage just came down by half naturally. So I asked them, how much can I pay? Can I put down there? They said, you can put down this. And I make sure that one of those years, I put down that amount. Believe me, because I'm using my own as an example and we are learning here. So I brought my mortgage from 30 years, 25 years. Like I'm talking to you now, I brought my mortgage to 9 years.
Wow.
Less than 10 years with what I have done. So I still have, after paying my mortgage, paying double payment, I can still put some money in investment. So there is no question of I am paying, I am losing money anywhere because I believe in investment too. I have invested a lot in the past too. Investment is not sure too.
Yeah.
So the money I have put on my mortgage and the money I've reduced in interest payment, if the money that I'm now using to invest, if in future anything happens to the investment, I come back to my mortgage as my gain. And anything can happen to mortgage too. I will give you an example. The house that I bought, the owner bought it at 312,000 about 16 years ago. And I bought it from him at 269. So anything can happen to mortgage. Anything can happen to your mortgage. That equity that you are calculating may not be there in future. The investment you are thinking about in future too may not happen. I have invested in stock before that. It was growing. When I was coming to Canada, my investment in stock was worth more than almost $400,000. So when I came here, I left it there. After about 5 years, it came to nothing. The company went down. So there is no sure thing in life. So I think I would advise anyone, if you want to buy a mortgage, run the numbers, make sure you buy a house that will not be too expensive, that all your money will not be going to the bank. At the same time, you'll be investing in the mortgage, and at the same time, you can have money to invest in stock market, crypto, or whatever you want to invest on. So these are the things everybody should consider. So as a landlord, I am not losing anything because the amount I am paying is so comfortable for me. It's what I will still be paying outside. That is just my simple contribution. Thank you.
No, it's very insightful. Thank you so much, Osman. I think you raised very good points there to say the key thing, Blooming and I, we emphasize with our clients when we are coaching them, please always educate yourself. Investing is risky. Either you're investing in real estate, you're investing in, always educate yourself. If you are not sure, they are experts, right? So the mistake some people do is they wanna, do things that they have no background in. Okay, I see Winfred, your hand is up. If you can tell us where you are from, and then you can go ahead, please. Thank you.
Yeah, I'm in Edmonton here in Canada. Yeah, this session is really, really informative. For me, I think sometimes people just dive into things according to what is obtainable in the area, without actually running the numbers like you guys are just running the numbers. For me, when we got our place, it was just a matter of comfort, having stayed in the rental apartment and all the disturbance and all this and that, it was like, okay, let's get a place for ourselves. So we just dive into it without like anything. Then having an accounting background myself, when I ran the amortization, it was like heart-wrenching. I was like, what is this? So we started complaining actually, and being a family of just 3, what we got was way more than as if we're planning to just run a family of 10 or so, So it was like, did we really check this thing? Until, just like Mr. Decker said, we got to know that sometimes you can You know, you can do the double payments and keep bringing it down instead of extending it to the length of time and just pay all that thing, you know, all that amount that is accrued to it. Then another part of it is this. When you consider the stock market, you know, when you consider the stock market, I don't know whether it favors some people or some people just know how to do it. I know there was a time my husband invested in, I think it's Bitcoin. I don't know, it's Bitcoin. And it was like, we lost a lot of money and we were like, okay, you know. So imagine you are living in a rental apartment and you are banking or you are investing and the thing just go down the drain. That has been scared us from investing, because if he did that investment, and back then in Nigeria too, I did some stock stuff and all that, and everything went down the drain. As a matter of fact, when I went to Nigeria and I started checking all these things, I was like, it's like I just wasted money. The only good thing is that the little pension I had with the bank, that one was just going on. I said, okay, thank God, at least that one is there. So sometimes it's just a question of what you really want to do, you know, or being educated before you start. Because if you have all the knowledge before you start, you cannot choose, okay, I want to be in a rental apartment, or I want to be in a home. Or if you are going to be in a home, like, in fact, everything I'm saying now is like when Mr. Dekere was talking, he just mentioned everything. You look at the size and compare with where you are coming from, the rent, before you go into it. And when you're equally going into investment too, you look at you go for people that are very, very knowledgeable, that can guide you, not people that will just, okay, invest in this and they will turn their back. Before you know it, you just fall and you begin to regret, why did you even do this or do this? I will say, I think both of them are very, very relative. But the foundation is that before you go, just go into it. Not like me, that after going into it, and I went to run the numbers and I almost ran mad for what the money that we're going to be dropping, giving the bank just for free. Yeah, that's it.
Yeah, thank you so much, to Winifred. I think that's very insightful in the sense that, before we buy a house, it's important to run the numbers. And I really appreciate the specific examples that you gave. In terms of investing, again, when most people start investing, they don't invest in educating themselves first. That is really the game changer. For example, if I have a brand new car, definitely a Tesla, it can be any other car. So, for example, if I had a brand new car and I have a toddler who is 5 years old, as a good parent, I think it would be very, very stupid of me to give the car to the 5-year-old to drive. But this is the same car that me as an adult, I can drive. I go to the grocery store, go for shopping, go for traveling with it. The same vehicle is safe for me, but when you give it to a toddler, it becomes an instrument for destruction. The same thing with investing. Most people jump into investing without understanding what exactly they are investing in. And that's really what really makes the difference. Yes, a lot of people might say, I've been investing and I lost some money. Definitely, it's possible. But the moment you give yourself the opportunity to educate yourself first before investing, you literally makes the possibility of you winning and investing better. Again, I'm going to emphasize this over and over and again. Whether you're a renter or you're a homeowner, if you are not investing, you are definitely 1,000%, 1,000,000% wasting time. The S&P 500, even if you want to be very conservative, yes, the stock market can be risky, but the S&P 500 has an historical track record for several years, several decades. That, okay, if I just put my money in the S&P 500, and you don't even do anything, it's going to trend upward. This is something that has been proven over time. But the moment we start talking about maybe investing in individual companies, individual stocks, then that can be a little bit dicey. But if you just invest in a basket, in an ETF, for example, or in an index fund, it really makes sure that no matter what happens, you're still going to be in the green over a long period of time. Again, I appreciate all of the comment, the contribution. Whether you're a homeowner, it's good. You're a renter, it's good. You're an investor, it's good. The most important thing is to find what works for you. So thank you so much, everyone. I hope there is no more question before we round up for
I
today.
I think as we wrap up, I think there was someone who asked
Mr. Otto.
where Mr. Edekere got that house for like 200 and something thousand.
Okay,
Yeah.
I'll allow him to talk.
Yes,
Yeah.
I've replied the person privately. I live
Okay,
in
good.
Edmonton, Canada, and that's where I got the house. I got it at 268,000 3 years ago.
Yes.
Thank you. And something I
Thank
wanted to add to give context here, like in Canada, for example, it may be different in the US or other parts of the world. Canada has 10 provinces and territories. Therefore, there are some nuances about the tax. The tax in BC, the tax in Alberta may be different from other parts of the world. Even Ontario, like the rate at which the property appreciates, even the cost. So those are nuances, like I said, Blooming and I, if someone then has a specific situation, wants someone to run the numbers. And this analysis was just a simplistic analysis to kind of like, show you what is possible and what is not possible. And again, like what my colleagues mentioned, it's personal. It depends on the person's preference. And another important thing is some people may just want for the psychology to just want the house to just own it psychologically, regardless of whether it's rational or irrational. Thank you so much.
Thank you, Isaac. Does anyone have any other question before we round up today's session? Does anyone have any other question or contribution before we round up for today's question? Again, there are no stupid or dumb question. Our goal is to make this as interactive as possible and to learn. Going once.
Okay, it seems like I don't see any question, but just out of interest, like we are going to be posting this, like for those who may have come late, so you can also watch it, and probably if you want to read through the slides, you can pause and watch it as much as possible. So Blooming and I, we will be posting this particular presentation so that you can watch it at the pleasure of your comfort. Thank you.
Okay, so yes, just wrapping up. Again, if you want to connect with us one-on-one, you have our information on the slide deck. You can reach us to us personally, either through our website or to our social media platform, the same handle, Blooming Morin or Streetwise Economics or Isaac Jonas. We're more than happy to attend to you. And again, thank you so much for attending today's webinar. Thank you for making this very interactive, and I hope that you learned a thing or two from today's session. So thank you.
Yeah,
Oh,
thanks.
yeah,
We will be posting for sure.
yes, we'll post it.
Give
We'll
us a
post
bit
it.
of time,
Yes,
but we will do
post
so.
it.
Thank
Yes,
you.
we'll
Thank
definitely
you,
post
Joe.
it. All right. Thank you, Joe. Thank you, everyone. Have a good one.
Thank you.
All
Bye.
right. Bye-bye. Bye.
Okay, thank you.